I sort of feel like this flips that whole risk and return thing in finance upside down. I mean, typically we've been, educated and trained to think that the higher risk, the higher the potential return. But in this case, with low volatility stocks, you actually get basically market-like or maybe even higher returns in the market with less volatility. So it really does, in terms of the risk-based explanation about why a factor works, it just doesn't really intuitively make that much sense.
It's a tougher one to even, it's even tougher than quality to try to explain this. Because if you go back to our principles from the beginning, are you taking extra risk by investing in low volatility? By definition, you are not. So that you really can't come up with a risk-based explanation. So now we need a behavioral-based explanation. And the most common one is that many investors don't have access to leverage. And so in order to add risk to their portfolio, investors that don't have access to leverage will buy these higher beta stocks to try to boost their returns. And they then will overprice those high beta stocks. And so they're effectively underpricing these lower volatile stocks, even though they're less risky. So that's the best explanation. And that's a reasonable explanation. But again, when you look at it relative to value momentum, it's a little bit tougher of an explanation to follow than the behavioral explanations for those.